Today, we're going to talk about interest rates, financing, and everything that is so interesting going on right now in the world of mortgages. I can't wait.
Stephen Bowen with Guild Mortgage here to talk about kind of what's going on right now.
Weird.
Yeah, it's unprecedented right now. Yeah.
Nice word.
Yeah.
So like 4 weeks ago, the Today Show posted on a Friday morning, 5.98% interest rates. And that was the top thing. And I felt it that weekend. I felt buyers being like, Jenny, I gotta find a house. I'm worried now that somebody I felt a little bit of a frenzy.
Yep.
And I also feel like that lasted for 28 minutes. Mm-hmm. And by Monday, rates were going up.
Yeah. Yeah. So we did have a lot of momentum. I mean, you have to kind of look back though and kind of see where we've come from. So we were at 8, then we were at 7s, then we were at 6s, and then we kind of touched the 5s. And then we had the conflict in Iran happen, and overnight, interest rates went up. And people were like, well, wait, hold on. How does that have anything to do with mortgage rates?
Well, especially because I know you said to me that the last 4 wars that started or whatever, rates went down.
They went down initially. So what happens is initially when they go down, when that happens, initially they go down. This time, historically they go down initially. And then inflation that's caused by oil or just different things or excessive government spending, typically the rates then come back up. In this case, we literally overnight, everybody that buys and sells mortgage-backed securities, they went in and said, oh, yeah, inflation, right? Because we're coming from this environment where we have PTSD over inflation.
Yep. Even though it's not actually a problem right now.
Yeah, it's
right?
not actually really a problem right now. So it's not as big of a problem as it was, right? Because we went from 8%, 7%, 6% on the rates. And so this was a knee-jerk reaction. Mortgages are bought and sold in a secondary market, mortgage-backed securities. And essentially they said, oil, lots of oil over here. Well, that's going to cause inflation because if you think about it, it's not just the gas we're putting in our cars. Factories that make our clothes. I mean,
jet fuels, travel,
everything, mm-hmm. Travel, you name it, right? And so then they started trading in a different way, and then rates popped up. So, do we think it's short-lived? I hope so. I hope it's short-lived.
So let's talk about your crystal ball. So that happened, and you said this morning to me that some of the bleeding has stopped. So yes. What does that look like? What does that mean today?
So Fed Chair Powell came out and said, hey, I don't think we're going to see long-term inflation from this conflict. And so that kind of stopped a little bit of the bleeding this week. Interest rates were kind of on a trajectory where it was like, oh my gosh, when is this going to stop going up? Mm-hmm. We went, from national average of about 5.875 to 6 to 6 and 8, 6 and a quarter. Now we're closer to 6.5. And we thought it was going to keep going. And with some of the comments made by the Fed, they were like, hey, no, this isn't the end of the world. This is a temporary blip. Hopefully it ends sooner than later. And I think that's where my crystal ball is. When does this conflict end? Mm-hmm. I mean, and that's your guess is as good as mine. It could end tomorrow. Right. It could end in 2 months. My hope is that it's done by, summer, mid to late summer. And then once my markets, which are scared of inflation, see that business as usual, then we'll start to see those come back down. I mean, the good news is, if you look at the last 3 years, these are still some of the best rates we've had.
No.
There's not as good as 5.99,
yeah. Well, and I think I feel like buyers overall understand that rates are in the 6s. They understand that, they get it. They're making plans based on that. I met with people yesterday who have a 3.125 on their house that they lived in for 20 years and they've refinanced it. And, they're retired and they're ready for the next chapter. They want to move closer to family. And the conversation yesterday was like, Jenny, we're just going to do it. We just keep waiting. But there's what are you waiting for, right? Yeah. At some point you just have to jump and you have to do it. And I think having Guild's no cost refinance is a big thing right now with my clients. Mm-hmm. Being able to say you will be able to refinance, and yeah, you'll have some title and escrow fees, but the lender's not charging, right? That helps that math problem. But it is just a math problem, right? I'd love to refinance the mortgage on my 2 things that we did in August. And I was waiting.
Yeah, we were getting close.
And then I feel like we're back we're back away from it. And so I'm still just waiting.
I think one of the most important things, regardless of where rates are, honestly, when rates were at 2%, 5%, 8%, the clients always have the same, probably the most important thing, and that's the impact to their household, right? Mm-hmm. What is my monthly payment? If we focus on that, and we run payment scenarios for people before they see the houses, and we ensure, hey, regardless of where the rates are, because we can't control the rates, regardless of where the rates are, is this payment comfortable for you?
Right.
And if they say yes, then do it, because that's the highest rate you're going to have, because then you can bring that down with refinances from there. The most you'll ever spend is that day that you buy it, with the opportunity to lower it later.
So are you recommending to your clients right now that they lock once they're under contract?
100%, because it's so unpredictable. We were starting to feel a little invincible because we were on this trend for about 6 months where it was like we were at like right around 6%. And then bang, just 24 hours, 48 hours, and next thing those rates are gone. Right now, like this month, maybe next month, the next couple of months, if you're comfortable with the payment and you're okay with it and we can't control the interest rates and we know they're volatile, we're going to lock it and walk away. I had multiple clients the week that was happening lock at, say, 6.1 or 6% or 6.25. And now we're at 6.5. So those people are very grateful, but we don't have that crystal ball.
Right.
So what we can control is, are you cool with the payment? Lock it in. You can always refinance later.
We were talking about a client of mine that wanted to do a 20-year mortgage instead of a 30-year mortgage. And you said something to me that amazed me, which was that the interest rate on the 20-year mortgage was higher than the 30-year mortgage. Can you explain to me why that is?
So mortgages, again, are bought and sold like a commodity. So it depends on the taste or the flavor of the investors that are buying those mortgage-backed securities. And sometimes we have inversions, and sometimes jumbo rate is better than conventional rate. Yep. And this just happens to be one of those times where my 30-year fixed rate happened to be better than a 20-year fixed rate because there was more appetite and more of those being bundled and sold in that secondary market, which is interesting. Same thing with ARMs. ARMs sometimes will come and go. Sometimes the ARMs will be a 1% rate improvement. Sometimes it's only a quarter. It's not worth the risk. And so it is interesting because we're not a one size fits all on rates. And that's why when I'm running scenarios for clients, we'll run a 15, a 20, a 30, and just kind of see what makes the most sense.
Can you explain to me, I was talking to somebody about this, and I know I didn't explain it well, about like, if you have higher income, you get a higher interest rate than if you have lower income. Like, I did not understand that.
So Fannie created it's kind of an income, like for people with lower income levels, they get a little bit better interest rates. It has nothing to do with your assets. It has nothing to do with your credit score. It has to do with your income.
Okay.
Lower income households get a little bit of a break off of their interest rates. So therefore, the people with the higher incomes feel like they're not getting that same break. And that was something that's, I think, been around for 3 years now.
But credit score still really matters, right?
Credit score is huge. So national average being 6.5%, that's national average for somebody with really good credit. If you don't have really good credit, you're high sixes right now. So I would say mid to upper sixes is the range. Credit is a huge factor. The amount of assets you have is not a factor in your interest rates. It's solely your down payment and your credit score.
And what's a good credit score today? Like what are the tiers? What do they look at?
Top tier for owner occupied, like conventional type financing is 760 or higher. As you go lower, conventional, I call them the snobs, 760, 740, 720, 700. Each one of those tiers gives you different pricing.
Okay.
So it is, a lot of times it used to be back in the day, right? When somebody said, oh, I have a 700 credit score. And we're all like, ooh, 700. And now it's like, oh, was it a 720 or is it a 760 or is it right? And so there are more tiers than I think what the consumer thinks there are.
Yeah.
In certain cases, we'll shift some clients. And that's why it's good that when somebody applies for a loan, they have access to all of the loans that we have. So we're plugging in different programs and different things. And so sometimes it might make sense to go to FHA loan where you're high sixes, because I call FHA the huggers. And so they go, oh, you have lower scores? It's okay. And so, but sometimes that might give you a much better rate.
And rates are better at FHA.
Rates are better at FHA, yeah.
But you have mortgage insurance.
You have mortgage insurance, and you have to refinance out of that, and there's some other little fees in there. So we always do the pros and cons of them. Yeah.
Why are the government-backed loans, VA, FHA, USDA, why are those interest rates lower?
Well,
and are they always lower, or is this?
They're lower, but you have to kind of look at the bigger financial picture of that. So you have an upfront financed fee. It's called an upfront mortgage insurance premium. So they're paying a 1.75% upfront fee on an FHA loan.
No matter how long you keep that loan.
Yep. And you're paying 1.75% upfront. It's rolled into your loan. So you don't actually see that. It's not an out-of-pocket cost, but they're rolling it in there. That's why they're offering those lower interest rates, because you're technically paying for that.
It's like a buy down sort of.
Yeah. But they're the huggers, right? So they're going to do those lower credit scores and all of those things. So it serves a really good purpose. Somebody with a 760 credit score would want to probably avoid that 1.75 fee. Yep. And that's why you would go there. But there is a thing where you kind of weigh the difference, right? Because if you end up at a 680, a conventional interest rate 7.25 versus 5.75 or 6%. So there is a a gap there. And that's why we're running multiple scenarios for the client.
I'm seeing a lot of family members, parents helping kids out right now.
Yeah.
And I love that. Like, I hope that when my kids are ready to buy houses, I'm in a position that I can help them out. So I love it. Is there a best path for that? Like, does it have to be conventional? Is it better to go FHA? Like, what are you seeing for the non-owner occupied co-borrowers? Or are you not seeing a lot of co-borrowers? You're seeing more just like gifts for down payments? Like, where's the power in that right now?
We're seeing a mix of both. So there's a lot of generational wealth transfer right now, right? Baby boomers retiring and people getting their inheritance early. I think that's a new thing. I actually like that. I think it's smarter. They can actually see their kids enjoy it.
Yep.
So I do see co-signing, and for the longest time, I mean, if we go back, because I've been doing this for a little bit, FHA was the only program that allowed that non-occupying co-borrower. And what a non-occupying co-borrower is somebody that's going to co-borrower to help you qualify, but they're not going to actually live in the property. It used to be just FHA.
Okay.
Now, conventional allows it, FHA allows it, VA does not. You have to be another veteran. But so it depends on their credit scores. So again, back to the programs. Yeah, really. Same conversation. We can do a non-occupying co-borrower conventional or FHA, just depends on that. If they have a large down payment, typically you don't want to go FHA because it has mortgage insurance, even if you put 20% down. Yeah. So co-signing is a lot, gifting is another, right? So sometimes people will gift those funds and just wire them directly to title and they wash their hands of it. So we are seeing a lot of that, a lot more than I've ever seen.
If a buyer is going to get a gift from family, should they get the gift and put it in their checking account? Should they do it directly to title? Like, what recommendations do you get? I know you have to trace the money, right?
Yes.
Like, it just can't be mattress money. It has to be like documented gift from parent, from family member, do you define even what family is, or do you just?
We take their word for it.
Okay.
People are honest. So what we're doing, honestly, there's the path of least resistance. And I always tell my clients, it's your pain that you're going to go through, not mine. Because I'm going to just say, hey, I need all this stuff. If you have your parents, there's literally a one-page form.
Saying it's a gift.
Saying it's a gift, who it's from, who it's to, how much, what the amount is. It is very simple. And if your parents wire the money directly to the title company, done. If you have their parents give you the money, then we have to wait for that money to clear. And then we have to wait for your bank statement. Oh, wait, you're not going to get another bank statement by the time that we're closing. Okay, now you have to go get a manual statement. And it creates this kind of snowball effect of documentation because they're always looking for money laundering.
Yep.
So it's like, where did this money come from? And why did you say there was 100,000 and it's only 90,000? And where did that other 10,000 go? And you start going down this rabbit hole and then tracing the money. And did it really come from your parents' account versus signing a gift letter, wiring the money to title? Super easy. So my suggestion is always to do that. And then sometimes the parents don't want to do that. If a transaction falls apart, then that money gets wired back to them.
The only disadvantage on my side with doing it that way is we do have to disclose if the buyer doesn't have the funds already, we have to disclose it as a gift. Whereas if they already have the funds, then I don't have to then they already have the funds. Right now in the market, I'll tell you that's not mattering too much. But like in 2021, it mattered, right?
Yeah.
So like it is a little bit market specific. But I tell people just to have I have to work with you, process it through, but we have to track it.
I haven't noticed that difference though. Like gifts were like, ooh.
Nobody cares
5-6 years ago, nobody cares now. They're like, they're expecting it. I mean, I would say half of my deals have some form of a gift.
Oh, yes. I'm sure I'm about that too. Yeah. And I appreciate it. Like it's helping these first-time home buyers. And honestly, not just first-time home buyers. Some of my second-time home buyers are having gifts right now, right? Yeah. Just because the world is expensive. And I like that generational wealth transfer. Like that's an interesting,
that's great.
Maybe my mom's listening to this because that would be great. So let's talk about pre-approval versus pre-qual versus they just talk to you on the phone. Like I tell my clients that to write an offer, I need a pre-approval letter.
Yes.
And then I tell them I want it from a good local lender.
Yep.
And I explain why you and I partner a lot. Like, right? Like why, like after interviewing like 34 lenders, like why I like working with you. What in your world, what's that process look like? Like what do they need to do to get that?
To get pre-qualified? I mean, there's a lot of different ways. So sometimes I have clients where they just go to my website, fill out a loan application. We've never talked and I work through it. We schedule a time to go over it. I prefer, but I actually don't prefer. I don't have a preference, but most of the clients that I'm talking to will reach out to me via either the agent or a group email or a group text or something like that. We schedule a time to talk. We talk and I actually manually on a piece of paper, like how much money do you make? How much is yours at? How much money are you going to have for down payment? And we work through their scenario manually. And I think it's a lot more personal versus them just filling something out online because I'm asking some probing questions. Well, tell me about that income. Are you self-employed? Is there a commission in there? Are you working under the table? Are you this? Are you that? And those are things that you can't be asked on a filling in an application. So I do that normally, just an initial consultation. We kind of build out a plan. And then from there, a lot of times they'll go back to the agent and say, okay, Stephen says I'm at between 4 and 450. And then I tell the client, like, if you think that that's a range that you're going to be comfortable in, then you need to come back and then fill out the application. So I'm letting them do that kind of first step consultation just to get their feet wet. Then once they filled out that loan application, it's so fast. Same day, 24 hours or less, you're getting your pre-approval. And then we kind of move into the next stages of, kind of.
Tell me what happens when you look at an application, you're talking to that client, and like we were just talking about somebody, and I don't remember who it was now, that needed to like go pay this debt off instead and not put as much money down on their house, but instead pay off this debt. So like what kind of, like, how does that come up in your conversations, or what does that look like?
Yeah. So a lot of times, I mean, we don't just give people yeses and nos. And I think that's just one of the reasons people are scared of lenders is like, I'm going to walk into the bank and they're just going to tell me no. And then I'm going to walk out there and I'm not going to have any answers. Yep. And so in certain cases, like in this case, actually, when you're referencing, she wanted to get to a higher price point. And so without getting to this higher price point, I had her pay down a couple other debts. And I'm like, well, instead of putting $150,000 down, we could actually pay off these debts that have these really high payments and high interest. Right. And we're just going to shift that debt from that double digit, 20% interest to your 6.25% or 6.5% mortgage. You're doing two really good things. And you're still eliminating the same amount of debt. You're still using your 150 grand. Yep. We're just utilizing it in a different way, but we just freed up $1,500 worth of payments. We're going to backfill it with $1,500 worth of mortgage payments, which takes you way up. So there's a lot of ways to do that. I've also had a few recently. I have some people in contract now that came to me and they had credit scores in the 500s. And we have a system where when we pull credit, we can actually pull these algorithms. It costs us money. We don't pass that to the consumer. And it literally will spit out a PDF of, if you pay this to this, if you pay this card down to $300, and if you do this one all the way off, and if you do this and that, your scores will jump. And this guy's scores went up from 5 something to like almost 700 in 2 months. And now is in contract on a house. So you don't always have to be 100%. Yeah.
It's the path.
You don't have to be 100% ready when you talk to the lender. I feel like sometimes people will come to me and be like, I wish I would have talked to you 3 months ago or 6 months ago, or right. And so I always say it's road mapping. You should road map 6 months early. Yep. Sometimes people road map a year early. I mean, that's pretty far out from me personally. But like 6 months, I mean, easy. Like, what should I be doing? Am I doing anything wrong? Am I doing anything right? These are the credit scores I have. Should I be doing anything there? Should I save more money? Should I, right?
I mean, I really appreciate it, especially when my sellers start that roadmap conversation with me early, because if they don't, I find they do the wrong things, right? They spend money on the wrong things. They update the house in the wrong way, or not wrong, that's the wrong thing, not in the way that's going to get them the best ROI. Yeah. And so they're spending money on things that like, they're all proud and happy that they did that. And then I met with a client yesterday and they have brand new window coverings. Now they are beautiful window coverings, but you and I both know how expensive window coverings are. Oh yeah. And no buyer is going to value their window cover. They're beautiful. They're very nice. They're very nice. And they put these beautiful vertical blinds on their sliding glass door. And I'm like, you're hiring me, so I tell you the truth and I tell you what I think. We have to take down the vertical blinds. And they're like, we just bought those. I'm like, we can leave them in the garage, and if the next buyer wants to put them back up, they can. But it dates your house. It makes you look like old people live here. And they are older. But I'm like, we can't have that aesthetic, right? That's
tough.
And so, like, and the rest of the blinds are all great. It was just a sliding glass door. Vertical blinds are the best application for a sliding glass door. But
it goes back to like consulting with somebody before. And some people are like, well, I didn't want to bug you. It's too early. No. Because I'd rather have a positive conversation now where it's proactive, right? Totally. And we can have those hard conversations versus I'm trying to buy this house and I found the house, my dream house, and it's on the market today and offers are due tomorrow. Yep. And then having that hard conversation of, sorry, you're not prepared. Yeah. And so I don't think you can ever be over prepared. I really don't.
And I tell my clients, like, I want them to shop their mortgage up front. So like these guys, they're going to be reaching out to you. They also bank with United Credit Union. So they're talking to United Credit Union. Great. This is the time to have that conversation, to talk, to make sure you're working with the right local partner that really gets you and understands you, so that when we fall in love, we have it. And it's not so much about like, they're going to qualify. They're going to qualify for way more than they want to spend. It's not about qualifying for me. It's about, are you going to be comfortable with that mortgage payment? Like they're used to paying X. And they know, because she's smart, she's been doing some math, right? She has a good idea of what that looks like when it's at a higher price.
Yeah.
But I feel like buyers, when they just go online and they use that like Quicken amortization table or whatever,
It's so wrong.
it doesn't really tell them
It's
everything.
not factoring in everything, and Zillow automatically populates like 20% down, perfect credit, like it's a one-trick pony, and it's never the right. It's never the right thing. And honestly, the first question that I'm asking my clients is, regardless of your wage, right? What payment do you want each month? Like, what is your comfort zone? What is your? And sometimes people will go, well, I don't have a comfort zone, and I'll be like, oh, okay, so a $10,000 mortgage payment. And they'll be like, well, no. And I was like, so you do have a comfort zone. But everybody does, regardless of what price range you're at. And there's a lot of those people buying their second or third homes that are having sticker shock. You know, they have a $700,000 mortgage at 2.5%, their payment's going to double, right? And so it's definitely important, even if you I know financing, I know 30-year fixed, I've owned a bunch of homes. You still need somebody guiding you through running those payment scenarios. And I like to run those payment scenarios live, especially when the market's volatile like this. It's, hey, send them to me before you're about to go out to the property. Okay, and that way we know, is this payment comfortable with what the market's giving me today?
Show it to them and they get excited, right? And they fall in love with that big walk-in shower and that closet and the backyard, and like then it's...
I would say there's no magical fairy dust that I can sprinkle on this to make this work for you. Same thing with buying something outside of your price range, right? Like if you're approved for 5 and you look at a house at 6 and you fall in love with it, well, of course you are, right? But that doesn't mean that we can...
Unless dad steps in and cosigns.
Unless you get a cosigner. That's the first question we ask is all the loans we already talked about, lots of loans you can get cosigners for.
Yeah.
So.
And when you get a cosigner, one more question on that. When you get a cosigner, that cosigner is fully liable, right? So like if adult kids don't make payments or are late or whatever, it reflects on
It's a co-borrower.
Okay.
So here's I think where people get confused because they're helping their kids, right? You can co-sign on a student loan and it's different than co-signing on a mortgage, depending on what you're doing. So with a mortgage, every person on that mortgage is 100% responsible for that mortgage. They're also 100% owner of that house. And so there is no like kind of side, I'm kind of over here hiding behind the tree. I'm kind of co-signing. No, you're 100% on the loan with that person.
Yeah. And I mean, I appreciate the co-signing as long as the person who's paying the payment really can still afford it. That's what worries me sometimes. Like sometimes we know they can because they are self-employed and they write all their income off and they like, we know they really have more cash available that they can prove. Sometimes it's a no-brainer. But sometimes I'm just like, oh gosh, like, I mean, are you really helping? I mean, are you really helping?
I've had that conversation with people. I'm like, well, technically this is like 75% of your income. I know you're getting a cosigner to qualify for this, but are you going to be okay with this? Like, is this going to mess with your quality of life?
Do you have a rule of thumb on that? Like your mortgage payment should be X% of your
Financial planners are saying 30 to 35%.
I hear 25% from really conservative ones.
So the super conservatives, I mean, I think that's probably fair. It also depends on how much debt you have. If you have, depending on your profession, some people have $300,000, $400,000 in student loans. So you want to kind of chunk away at those and maybe not. So it is a balance of.
I tell my clients, I don't want you to be house poor. Like I want you to still be able to go on vacation,
go out to dinner,
not feel like if you get to that like 60, 75% of your income as your mortgage payment, I mean, after taxes,
no life's happening.
There's no life. No.
I would say it defeats the purpose. It defeats the purpose of having a house if you're going to be miserable having the house. Like I do this really stupid exercise with clients if they really don't know what their comfort zone is. And I have them print out, like if they're credit card people, I put everything on credit cards, print out a couple months worth of credit card statements, highlight everything that's a non-negotiable. But that includes things like, drinks with the girls on the weekend and happy hour on Fridays with dad or whatever that is, a coffee every single morning. And you highlight all of those things and everything that's not highlighted, right? So your car insurance is highlighted, your bills are highlighted, is your excess spending. And people are shocked at how much they eat out, how many Amazon packages they're ordering. And I'm like, and sometimes
are you talking to me, Stephen?
Yes. And sometimes it's like $200. We're trying to get them up $200 on payment, right? They want a $3,000 payment. Now we're at $3,200 to get the house that they love. And I just have them go look at how much money they're spending. And you'd be shocked at how much. I mean, a grocery store trip's $200.
My rule, and it's kind of my mantra right now, is stop spending money on stupid.
Yeah.
And like Tom likes to say that a lot. And so it kind of is in my head. And like, if you think about that, I'll put stuff in my Amazon cart and then I'll let it sit there.
I save it. Well, what I've been doing is I put it in there and then I actually go to buy something I need and I'll see all this junk and then I save it for later.
And then do you ever put it back up and buy it? Or
No.
Good.
I've been better.
Yeah. No, that's it. Like,
But we all go through that.
absolutely.
Yeah.
And I think like for me, COVID really taught me how much money we spent eating out because we had so much more money when we weren't eating out. And so that has stuck with us. Like we eat out now more than we did in COVID, obviously, but we don't like, we are thoughtful. All right. I try to be thoughtful about that. Right. And that's just meal planning and slowing down and having something, because if you get home and you're tired because it's been a crazy day. And like last night I got home at like 8:30 from clients, right? Because now it's lighter later.
Yeah.
So we can look at houses later. And Darren and Carolyn are super excited to buy a house. And so we like, we're out there looking. But like, I didn't want to make dinner.
Yeah.
Right.
Yep. Yeah. It's interesting. The quality of life is number one.
Yep.
Right. We want to make sure that payment's comfortable, but you're also not sacrificing like life.
I do think that for some of my first time home buyers where we can see their trajectory of income going up, when they push it a little bit to start, it's only going to get better.
And that's a question I ask people is, hey, are you expecting raises next year? And, you know, I just actually had a conversation with a couple the other day and they were like, oh yeah, well, between the two of us, we'd probably be about $700 more a month. I'm like, oh, okay, that's awesome.
Right,
like,
that's going to make it
like that
easy.
will make it, that will, you know, then you're really close to what you're paying in rent right now. And so you're only going to be going through 7 or 8 months worth of like, we got to be a little bit tight for these 7 or 8 months. And most people can do that.
Yeah.
So that is an important question we ask a lot.
Yeah. Okay. Thank you so much.
Yeah,
I
thanks for
really
having
appreciate
me,
the conversation.
Yeah.
Let's just keep watching. Like it is. Just,
I know.
It is just crazy right now.
Let's rates in the fives. Rates in the fives before the end of the year.
I don't know. Do you have a prediction? Where are we going to be at the end of the year?
I think we'll be in the fives by the end of the year.
You do?
I do. Yep.
I keep making predictions and I keep being wrong, so I don't know.
You know what? That's why they're predictions.
Thank you so much.
Thank you.